Thank you. As you said, I'm Arve Hanstveit. Hard to follow that introduction. I'm here to tell you my experience about what it's like to be an early stage investor, something I've done since the early mid 90s. When you think about it, why would you get involved with this? To most people, just investing in the stock market is risky enough. And here you're talking about layering on an additional level or two of business risk, financial risk. And to top it off, when you put money in, you got to wait for years for a liquidity event to happen to get your money back, if it occurs at all. Doesn't really sound like an attractive proposition, does it? Now, fortunately, there are some attractive elements here, and you've heard it from some of the previous presenters, some of the things that I like. I enjoy interacting with the entrepreneurs, and some of the energy that you probably felt from Matthew identifies some of this. You learn from them, they energize you, and it's fun to be around them. And they have all kinds of ideas. Also, I like to be, instead of just being a passive investor, if I can be involved, I'd like to be involved. And some of these opportunities lend themselves to it. And getting exposure to new ideas, it's also exciting. And to top it off, if you do this right, it doesn't have to be a loss. It doesn't have to be, say, charity. You can actually make good money off of this. So how do I try and say improve my odds of making money here? If this is my or my set of criteria. So if this doesn't agree with you, if you want to open your own business, it doesn't mean that you don't have a chance of getting funded. It's just that you're not going to get it from me. You got to move to some other guy. So the first thing that I'm looking for is what I call a game-changing technology. Now, what do I mean by that? It could be a product or a service, and I'd like for it to have strong IPs that can get patent protection. It means that, say, like Mike's restaurant, I probably would not be an investor, because I'm not looking for a marginal improvement, design change to an existing product. I'm looking for a real step up, something that's much smarter, efficient, cheaper. And I'll give you a couple of examples of investments that I've been in. One is an energy recovery device for a salt water reverse osmosis desal plant. That's a mouthful. Now, what this device would do at the time of inception would be to recover energy in the desal process much more efficiently than the products that were at the market at the moment. They would recover typically 30-40%, maybe in the 20s more realistically, whereas this product would recover 95 to 98%. So if it were successful, it would completely replace these other products, which is what it eventually did, because the product's been on the market now for a number of years, has about 60-70% global market share, and not only did it gain large market share, but by the virtue of saving so much more energy, it reduced the cost of desalinated water, so the demand for these reverse osmosis desal plants grew as well, so you got a double whammy out of it. Another example is a software company, and I'm not sure if you guys are familiar with the term track and trace, but there's legislation afoot in the US and in Europe. There's a few years grace period here, but within a few years' time, most pharmaceutical companies will be required to be able to track and trace securely their medications down to the individual packages. Now that's going to increase the data mass enormously. So if you try and solve this problem with a traditional database system, you're going to be in for a lot of trouble. It's going to be financially probably prohibitive, plus other big hurdles. So what this company came up with, again, is a much smarter solution to this, where you basically bypass the need for database systems, have, say, mathematical algorithms plus and other neat features. And this product has also been in the market for a couple of years, actually in India, where counterfeiting is a major problem. So you've tested it out, it does work, and I just talked to the company the other day, and they just received a contract from one of the major pharma companies that actually had in-house an IT provider that would do the track and trace for them using a database system, had gotten overwhelmed, turned around and gave the contract to this company. And now we weren't even talking about big numbers. I don't think they were even into the hundreds of millions of codes here, whereas you're going to be facing hundreds of millions and billions. I'm very enthusiastic about the prospect for this company. Now, if we have this product, and then we go on to the team, the people that are going to make this happen, and this is really the most important element. As you saw in Matthew's presentation, he exudes a bit of what I'm looking for. It's energy. You can learn from this guy. He's committed. It's a lot of what you saw in him is what I'm looking for. Because see, when I look at the investor here, he's going to pull me in. I'm going to get excited about being part of his team. He's going to convince me that he knows what he's doing. He's onto the right idea. He can attract the right people to get this done. And eventually, then he can also convince the clients to buy his product. And these are all the elements that you want to see in a team. And I think that I think Warren Buffett had a saying that, if I can quote him right, if a mediocre management meets an excellent product or business, most of the time the management will win. And conversely, an excellent team can do wonders with a mediocre product. So the people are really more important than the product and the technology itself. And if you can match, say, the two, then you're really onto something. If we got these two elements together, then we're off to a very good start, because these are two of the most important ones. Then I would like to see a large addressable market, preferably globally. There's no point in going through all this effort and just having a little niche market, so you're never going to get a financial return out of it. So you got to make sure that you have a large enough market to service to make this effort. Second, or after, I'd like to see low capital intensity. Capital intensity can be tricky. Like in a lot of the internet and new tech ventures, the capital intensity up front may be very low, so the hurdles to get in seem modest, but then the capital intensity comes on later on in the commercialization phase. So you've got to be somewhat careful as to how you define capital intensity. But if you have a project here and you tell me that, say, a couple of years down the road, I'm going to need $100 million to build a test plant here to prove the concept, then this isn't for me. Then you're into a different, where capital is one of the major hurdles, and I'm not going to compete in that. Let's say now that we've gone through all of these and you finally have the product ready to go to market. And as one of the previous speakers said, then I'd like to see the scale. What I mean by that is that I'd like to see revenues now grow much faster than your cost. And that means to say, if you have a manpower intensive, like a retailing or something, that's not going to scale. So I'm not going to be interested in that type of venture. Going back to the two previous examples I gave, obviously the IT company has gross margins in the 90 to 100%, so it scales very dramatically. But even the product company has gross margins in the 60% plus, so it's a very profitable business. And if you have all of these elements together, then you have a real, now you can build a really, say, profitable global business that you can make real money out of. So now I'm really excited to put money in. And then what do we do after that? Then before we come to that, I'd actually like to have a couple of more conversations with you on exits and on valuation. And then if you then say, I'd like to hear, have you thought about exit? Because now I'm going to put money in, and at some point I'm going to need to get the money out. And have you thought of how can that happen? If you tell me you're going to like to build this company, hand it over to your kids, that's fine, but I'm not going to get an exit out of it, so I probably won't be able to participate in it. If you, on the other hand, say, I really want to build this, I want to take it all the way to the IPO, that's fine. I've actually done that once. I know what a treacherous and long and risky road that is. But look, if you then I would really like to hear from you that you understand the strength of the team that you need to have in place in order to make that happen, because this is a really challenging proposition. But if you're successful, it's probably the biggest payoff. So, and another one is just to make a trade sale where your product or service would fit as one cog in a bigger wheel. And this can be, say, lower risk, say, shorter time frame, could be financially very profitable for everyone. It may not have all the elements as an IPO where you can get a bigger name out there and all that, but it can be just as good or better, say, for an investor as an IPO, to put it that way. And then, given the reason why I want to have this discussion at the early stage is just to see if there's a meeting of minds or not here, so we know each other somewhat better. And then, if all this is done, then I really want to put money in. So now we just need to agree on a price. And then one of the most common mistakes I think I see in the early stages is that you tend to put too high of a value of the company at the inception, and it's easy to do. Everyone's excited. You haven't really had to go through any of the big challenges yet, so it's easy to overestimate the potential and underestimate the challenges. So then this is when I come in and sort of poo-poo the whole thing a little bit and maybe get people angry, but you gotta get the valuation down to a sensible level. And what's sensible? This is not this is art. You can't use discounted cash flow models or anything like this at this point. There are VC models and different models that are being used, and they kind of guide you. But I think you got to just use a little bit of experience, common sense, and then you can use a guideline where you try to look at an exit point and how far out it is, what's the likely price, and then discount that heavily backwards so you get to a value that you feel comfortable with, agree on that, and then you basically put money in. Because if you have a valuation, you put too high of a value early on, then things happen and you got to do a down round. Now that's going to have some negative repercussions on your company, because you've probably handed off options or whatever to your team. They work long days, they are underpaid, whatever, they look for an exit too, and now you got to go back and you have a problem. So you try and avoid getting into those situations if you can. So hopefully we can agree on all this, and then I'm ready to put money in, and hopefully we're off to something good. Thank you.